Hi all. In this video, we're going to discuss evidence of predictable behavior of security returns. This is a paper published by Jegadeesh in 1990. First, what is the research question? Much of the theoretical and empirical research in financial economics was based on the concept of market efficiency. However, some recent papers' findings could contradict the efficient market hypothesis. Specifically, some papers discovered evidence of predictability of returns on market indices and size-sorted portfolios. Similarly, previous literature has found evidence against the random walk model for individual stock prices. However, although the evidence of stock return predictability was statistically significant, they were not economically significant. The author wanted to further investigate stock return predictability. As such, the research question of this paper was to examine the predictability of monthly returns on individual securities and the economic significance of any observed empirical regularity. This research question is important because it provides new insight into the extent to which past returns could predict future returns. The findings of this paper could help investors develop profitable investment strategies and help researchers conduct future research on stock prices. Let's address some of the past literature connected to the research question. Fama in 1970 surveyed early tests that generally provided evidence in support of the efficient market hypothesis. However, some more recent papers found that returns on market indices and size-sorted portfolios were predictable. Fama and French in 1988 reported negative serial correlation in market returns over observation intervals of 3 to 5 years, and Lowe and McKinley in 1988 reported positive serial correlation in weekly returns. Regarding individual securities, French and Roll in 1986 reported statistically significant negative serial correlation in daily returns. Furthermore, previous literature had found stock returns to exhibit anomalous behavior in January. Branch 1977 and Ranganum 1983 found that stock returns in January were negatively related to returns in the previous year, and Jegadeesh 1989 found that the long-term mean reversion of market returns reported by Fama and French in 1988 was concentrated in the month of January. In terms of the data utilized in this paper, Jegadeesh obtained security returns data from CRESP, the monthly returns file. Tests were conducted over the period 1929 to 1982. This cross-sectional regression model on the slide was used in the empirical tests to examine the serial correlation properties of returns of individual securities. This table presents the cross-sectional regression estimates using the model presented on the previous slide. In the sample of all stocks over the period of all 12 months, the regression estimates revealed a pattern of serial correlation. Coefficients at lag 1 and 12 have high magnitudes, and most of the coefficients are statistically significant and different from 0. The F statistic under the hypothesis that 1, all slope coefficients are jointly equal to 0, and 2, coefficients from lag 2 to lag 14 were both able to reject the null hypothesis. To investigate the January anomaly effect, tests were repeated within and without the month of January. In the sample period excluding January, coefficient at lag 1 was still negative, while the other coefficients were positive. Most coefficients were statistically significant. The F statistic under the hypothesis that all the slope coefficients were jointly equal to 0 was large enough to reject the hypothesis. Thus, the results over the period of all 12 months were likely not driven by anomalous return behavior in January. On the other hand, when January was considered separately, the coefficients exhibited a different pattern of return behavior. All slope estimates from lag 1 to lag 11 were negative, while the higher order lag coefficients were positive. This was consistent with previous literature, which found that loser stocks in the previous year experienced abnormally high returns in January. Jegadeesh also examined the pattern of serial correlation across different size groups. Subsamples were constructed based on size. Stocks in the sample were sorted on market value of equity and assigned to quintiles. Q1 represents the quintile of small firm stock. Q3 represents the quintile of medium-sized firm stocks. Q5 represents the quintile of large firm stocks. The pattern of serial correlation outside January was similar across the size-based quintiles. However, in the month of January, the absolute magnitude of the slope coefficients for the group of small firms were generally larger than the corresponding coefficients in the other size-based groups. Jegadeesh noted that although not presented in Table 1, he divided the test period into 4 roughly equal subperiods and conducted the same test within the 4 subperiods. Analysis of the regression estimates within these subperiods suggested that serial correlation in security returns was not confined to any isolated subperiod. Using the discovered pattern of serial correlation, Jegadeesh formed some predictive portfolios. He used 3 different trading strategies: S0, S1, and S12. Securities were ranked in descending or ascending order on the basis of predicted returns, and 10 predictive equal weight portfolios were formed. Then abnormal returns earned by the formed portfolios were estimated using a market model. The order of ranking of excess returns across the 10 portfolios formed using S0 exactly matched the order predicted. The first 5 portfolios experienced positive abnormal returns. Note that the difference in abnormal returns between the top portfolio and the bottom portfolio was 2.49% per month. The patterns of abnormal returns across all the predicted portfolios within and outside January were qualitatively similar to the patterns of the all-year period. The patterns of the abnormal portfolio returns under the strategies S1 and S12 also closely match the pattern implied by the signs of the observed serial correlation at these lags. The differences between the abnormal returns on the extreme decile portfolios under S1 and S12 were respectively 1.99% and 0.93% per month. Jegadeesh noted that these predictive portfolios indicate that the serial correlation could have economic significance. After accounting for transaction costs, trading strategies that would long the top portfolio and short the bottom portfolio, as determined by S0 and S1, could yield average abnormal returns of 20.8% and 13.9% per year, respectively. S12 would not be profitable due to trading costs. Tables 3 and 4 present some auxiliary information regarding the predictive portfolios formed using the 3 trading strategies and their respective abnormal returns. In Table 3, note the large difference between the proportions of positive abnormal returns on the top portfolio and the bottom portfolio in any given strategy. In Table 4, note that at most, an average of 51.6% of securities in the predictive portfolios under one strategy were also included in the predictive portfolios under another strategy. In order to examine the possibility that the market model was inadequately adjusted for certain size-related risk, the author estimated abnormal returns on the predictive portfolios using a size-based model. Across the 3 strategies, the estimates of the abnormal returns on P1, P10 were close to the estimates of the abnormal returns under the market model. However, when the month of January was considered separately, the estimate of the abnormal return under the size-based model was significantly less than the market model estimate. This suggests that the size-based returns model could account for a part of the empirical anomaly in the month of January. However, much of the empirical regularity was left unexplained. The author then ran another test to eliminate potential bias due to the bid-ask spread and thin trading. In panel 1 of table 6, portfolios were formed under strategies S0 and S1, and the prediction was based on the returns in month T-1. In panel 2 of this table, portfolios under strategies S0 and S1 were formed using the returns in month T-1, excluding the last trading day. Returns on the last trading day were not used for a prediction in order to avoid potential bias due to the bid-ask spread and due to thin trading. Note that the abnormal returns in panel 2 were smaller than the abnormal returns in panel 1. However, even after this conservative control for potential bias, the abnormal returns earned by the predictive portfolio remained fairly large. Anyway, that concludes the discussion of this paper, and I look forward to seeing you in the next video.